The other half of the monetary system is payment systems, which also come in many shapes. And sizes. Unlike money, payment systems are not always interchangeable. Payments. Such forms as checks, credit transfers, direct debits and card payments. Handle large value and high priority payments like interbank transfers. Two worldwide trends have been driving change in payment system design for quite some time. One is speed. The quest for speedier payments is long-standing. To be acceptable, today, it seems like an eternity. Communication via email and social media expect to be able to make instant payments. Systems for retail payments, fast payments, have recently emerged. Receive funds within seconds, anytime and anywhere. Settlement, RTGS, systems have been speeding up payments for much longer, since the 1980s, in fact. They are now the standard around the world. Globalization is increasing the demand for cross-border payments. On an intricate web of bilateral relationships between commercial banks, known as correspondent. Banking. But multi-currency systems are emerging. Within one jurisdiction or across multiple jurisdictions. Instant Payment Settlement Service, or TIPS. The system allows retail payment service providers to offer Funds transfers in real time around the clock. Both money and payment systems are essential to the functioning of a modern economy. Rely on trust. Later. Disruptions or bank defaults. Maintaining trust in the monetary system is a first-order public interest. Most countries, the central bank is the institution charged with this task. A future monetary system with CBDCs. A thought experiment: what would a future monetary system with CBDCs look like? Important point at the outset. Cashless systems are being developed very rapidly. Systems through your mobile phones. Companies are testing cashless systems. To pay technology using facial recognition software. So, to be clear, the CBDC debate is not about the technology or its look and feel to the customers. Making payments. Then, what is it about? It's partly about the potential decline in the use of cash, and what central banks should do about it. Embraced electronic means. Increasingly reluctant to accept paper money. Rapidly. Payments. Graph 1. But for most countries, cash is still in high demand. The amount of cash in circulation has actually increased over the last decade in tandem with electronic payments. Urgency to come up with a substitute for cash. Banks want to be prepared. A cash substitute is in any case only one potential form of CBDC. Central bank committees based at the BIS identified two main CBDC varieties. Be restricted to a limited group of users and used for interbank payments and other settlement. Transactions. Tokens or on accounts. Bank of Ireland. We can see how cash compares with the retail CBDC in the last two columns in Table 1. A CBDC could and would be available 24/7, 365 days a year. Say, stopping off at the supermarket on the way home from work. Option of paying cash. CBDC is not necessarily anonymous, like cash. In terms of technology, it would be easier to replicate the attributes of cash, if so desired, in a token-based version of CBDC than in an account-based one. Broadly untested, whereas the technology for an account-based CBDC has been available for decades. FAR, central banks have generally chosen not to provide such accounts. Why not? The other major issues underlying the CBDC debate, the impact on the financial system. The current system has two tiers. Bank is the other. U. From Joe's, the two banks settle the payment through the central bank. Account and credits your bank's account, making sure the payment is final. At the moment, these settlement accounts, shown in the second column of the table, are the only form of CBDC. CBDC beyond the current circle of commercial banks. Banks play an important role as provider of financial services to citizens and businesses. That the Central Bank of Ireland and the ECB were to offer deposit accounts to everyone and then issue debit cards and mobile phone apps for you to make payments with. Would be taking on the customer-facing business lines. New staff to handle this line of business and to handle customer inquiries. Bank staff are very good, and they would be capable of taking on customer-facing tasks. The main issue. Safety could be an important reason to deposit money in the central bank. More customers would prefer to have deposit accounts at central banks, and fewer at commercial banks. A shift of funds from commercial banks to the central bank could be gradual at first. Turn into a flood. If bank deposits shift to the central bank, lending would need to shift as well. The deposit business, the central bank would be taking on the lending business. Need to meet business owners, interview them about why they need a loan, and decide on how much each. Should receive. We can ask ourselves whether this is the kind of financial system that we would like to have as the ultimate setup. Bank could make do without a lending operation if it sends customer deposits to the commercial banks. By opening central bank accounts at commercial banks. Commercial banks so that they could lend on to the customers. However, the bigger issue has to do with the division of labor between commercial banks and the central bank. The central bank is a public institution charged with ensuring that inflation is under control. The economy runs smoothly and the financial system is sound. Commercial banks are private businesses that thrive by attracting and serving customers. They need a different mindset, constantly innovating. They tend to have more staff than central banks because serving customers is resource intensive. To be sure. Supervision and regulation need to be in place so that commercial banks do not jeopardize the financial system through reckless behavior. There are historical instances of one-tier systems where the central bank did everything. In the socialist economies before the fall of the Berlin Wall, the central bank was also the commercial bank. But I do not think we can hold up that system as something that will serve customers better. Less dramatically. Publicly owned banks in many developing economies are hardly paragons of efficient allocation of funds. Or of good service. Although established with the best intentions, in practice they often verge on being highly bureaucratic institutions susceptible to political influence, in particular to directed lending to politically favored sectors of the economy. In any case, token-based CBDCs may be less prone to this type of structural shift from the commercial banking sector, as the outstanding amount of the CBDC can be fixed. However, there would then be the question of whether these tokens would start to command a premium over bank deposits. Would such a premium fluctuate over time with shifts in uncertainty and financial conditions? Where do central banks stand? The Committee on Payments and Markets Infrastructures, CPMI, at the BIS last year surveyed central banks to take stock of current work and thinking on CBDCs. But only about half of these have moved on to the next stage of actively testing the idea, as Graph 3 shows. If we go one step further and ask central banks whether they plan to issue a CBDC, the picture is quite telling. Obviously, this is consistent with what I argued earlier, namely that, a, the introduction of CBDCs would have a major impact on the financial system, b, there is not yet a noticeable and widespread fall in the demand for cash. And, c, central banks do not feel compelled to face a major change in the way they conduct monetary policy. Conclusion: I have outlined some of the issues around CBDCs that central banks are evaluating as we move deeper into the digital age. "10 years after the great financial crisis, where do we stand?" Lecture by Augustin Carstens, General Manager, Bank for International Settlements, People's Bank of China, Beijing. November 19, 2018. Good afternoon, everyone. I want to thank Governor Ye Gang and the staff at the People's Bank. Of China for hosting me today. 1 month ago, Governor Ye came to the BIS representative office for Asia and the Pacific in Hong Kong to join the celebration of its 20th anniversary. When the BIS Asian office opened its doors, in July 1998, the world was quite a different place, only just emerging from the tail end of the emerging market. Crises of the 1990s. The 20 years since then have seen a marked rise in the economic weight of emerging market economies, EMs. China. In particular, expanded rapidly as its share in global GDP, measured in PPP dollars, rose. From around 7% to about 19%. At the same time, the economic resilience of EMs improved significantly through the pursuit of prudent policies. This enhanced resilience became visible during the Great Financial Crisis, GFC, 10 years ago. At the time, EMs, especially China, made an important contribution to global economic growth. Buffering the negative shocks that came from the financial crisis. The GFC has been a defining moment for today's macroeconomic and financial landscape and sets the stage for monetary policy going forward. Both in advanced and in emerging market economies. In my remarks today, I would therefore like to focus on the question of where we stand. Ten years after the onset of the GFC. What were the policy responses, particularly with respect to monetary policy? What has been accomplished? Were there unintended consequences? What are the challenges going forward? And what are the policy implications at the current juncture?